Hello from the sidelines of the IPO Summit here at the New York Stock Exchange. I'm Jarrett Banks of IPO Edge, joined by my guest, Craig DeDomenico, a managing partner at Stifel. Craig, welcome to the program.
Thanks for having me. Good morning.
It's an exciting day. Amer Sports is going public. It feels like the IPO window is finally opening. Do you think that's the case, and what's different from last year?
Yeah, sure. Thanks for the question. It's obviously great to be on the floor this morning watching Amer celebrate the opening. But yeah, we think the IPO waiting game is over and it has reopened. That said, we don't think it's full risk on yet. We think that the rate curve is obviously playing ball, and most importantly, companies are more comfortable guiding projections, and that's obviously the key variable as we advise companies and they think about the timing of going public. On a numbers basis, we've had 9 IPOs so far in January. Put that in perspective, that's the most we've had since the boom market of 21 and before that, 2018. So we're pleased with the start. That said, ECM bankers need to be careful. We need to be maniacally focused that the story around each of our new issues is there, and that there's a reason for these companies to be public. So we're cautiously optimistic.
Right, now you're a consumer sector specialist. Is that a good place to look for more IPOs this year?
Yeah, we love the consumer. Amer Sports is obviously a branded products company, and you can see everybody's not in suits, they're wearing their own apparel, and there's definitely certain subsectors of consumer that we expect to be a big participant in the IPO market this year. Our own backlog is about 15 consumer IPOs. Some of those, no doubt, will move into 25, but those are companies that are ready to get public and looking at that. So experiences, fitness, restaurants, pet. We think on the retail and food side, that's probably more like a 25 rebound, but we're hiring in consumer. We got 7 senior research analysts, and it's a very important vertical for us.
All right, great. What about restaurants? Could that be a hot area? We heard about Cava last year, but then others like Fogo de Chão went in a different direction.
Yeah, we love the restaurant business. You mentioned Cava. Cava is a fantastic story. That's a company that we think could have gone public in any market. Brett and Trisha do a fantastic job. Trisha's actually at this event today, so look forward to catching up with her. But from a Fogo perspective, when we advise private companies, we like to position everything as a dual track and look at multiple options. There's lots of different priorities in terms of returns, dollars needed, et cetera. And obviously, the private equity community will continue to look at private companies as an interesting alternative for their portfolios.
All right, now there's been some recent news with the SEC and SPACs. It's a little bit complex, but could you break that down for us?
Sure. So obviously the much awaited news out of the SEC that the street has been and kind of watching closely but preparing for over the past few years. But some of the most important updates are that both the SPAC and the target company now are both going to be co-registrants on registration statements. That means that the directors and officers from each of the companies will have to sign the registration statement. In terms of forward-looking statements, they're taking away some of the flexibilities that SPACs had always had from some of their history. So companies will be much more focused in terms of disclosure and the type of financial statements they're putting around on de-SPACs, and that will look more like an IPO. If you step back and just look at that in reality, Stifel as a firm has been working that way for the past few years on any of our advisory de-SPACs. In fact, we've always required 10b5-1 opinions from law firms as well as comfort letters from auditors as we were preparing for these changes. So I would say in general, we're hoping that these help rebuild confidence in companies on the de-SPAC process, and obviously we look forward to partnering on the rules, and we'll continue to do business in SPACs.
Staying on SPACs just for a minute, how do you look at SPACs as a path to public markets? It's looking more like direct listings these days, isn't it?
Sure. So, as I said earlier, with private companies, we like to have multiple options for them in a dynamic market. We think that SPACs will continue to be an alternative. For many of our companies, we'll tell them, let's get you IPO ready first, right? Let's get your S1 on file. Let's be prepared to get public. And then if a SPAC were to come over the top, we could obviously entertain that. About 2/3 of the IPO market comes from private equity and venture capital community. So by nature, a good portion of those owners are going to decide on valuation and what capital is raised. Many of them may prefer to have a fixed price IPO. And in those circumstances, the SPAC can provide some additional creativity.
Are de-SPAC companies still viewed with skepticism in your mind? What do they need to earn the trust of investors?
Sure. When you look at what's working, in the current environment, we're talking about companies with, billion plus of equity value, revenue and cash flow style valuation metrics, and projections that can be trusted, as we talked about earlier, and not just by the company, by the buy side, by the research community, et cetera. And as we take those type of companies and we put them into a SPAC, we think that they can earn trust. Those are going to be sought after IPOs, whether they go public in an auction-based format or a de-SPAC. That said, to answer your question, there are definitely some mutual funds that will want to see companies that go public in a de-SPAC format report as a public company for maybe a quarter, likely two, get research initiations out, and then before they step in a major way. They may play a little bit, but before they really step in and build a size position, they'll want to see those companies act like a mature public business first.
Great. Now, what about with a regular way IPO? How should companies think about the right size and price? Obviously, Amer Sports, being a high profile case here. Should secondary shares be a part of the deal?
Yeah, so when we think about the mix of, primary and secondary, we generally look at it as a lens of let's first fix the balance sheet, right? How much primary capital needs to get raised to make sure that the company can meet its forward projections. Once we solve for that, we will then look at a second metric, which would be we really don't want to sell less than 10% of the market value of the equity. So once we have those two solved for, then secondary become a big component. How much would you like to take off at the IPO? Would you prefer to wait for follow-ons? Many sponsors will choose to take dividends as a private company, take a little bit more leverage out, return capital then, and then push those into primary. But we welcome secondary shares in our IPO as long as we solve those first two metrics first.
All right, last question. How does the IPO pipeline look this year, and what's driving demand to go public?
Sure. As I said earlier, we're optimistic about a good year in 24 for IPOs. A lot of the supply is coming from deferred backlog, right? So we have a record backlog as do most of our competitive peers. We're coming off a year last year where you had a little over 30 IPOs. The year before that, a little over 20. So clearly, those are well below historic norms. As we think about the current backlog and what could come out, even in an election year, we could see as many as 100 US IPOs, which would be a big step up. That looks more like what we saw in 2016. For many of our clients who are coming from the private equity community, the venture community, there's a big need to return capital to their LPs. And in 2024, that's an important inflection year. As you've read about, it's a more difficult capital raising environment for those funds, and as a result, they need to return capital. And we think that's going to drive a lot of really high quality assets, not just to the M&A market, but also to the IPO market. And then the last point on that is just that the amount of bake-offs that picked up for ECM bankers across the street picked up dramatically in the fourth quarter. I can tell you our associates and analysts are feeling that with the amount of presentations we've done since then. So based on that, a lot of good high quality assets thinking about IPOs. If not, they're likely dual tracking. And these are going to be really high quality companies that fit a lot of those metrics of what people want to buy, as we spoke about earlier. So let's go.
All right, we'll leave it there. My thanks to Craig DeDomenico, a managing director at Stifel. I'm Jarrett Banks, signing off from the sidelines of the New York Stock Exchange.